Well, a warm welcome, everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial. Today we have Vivek Prabhu from Perpetual. Vivek is Perpetual's Head of Credit and Fixed Income. He joined Perpetual in 2004 and he has more than 30 years of experience in finance, investments, accounting, governance, and risk management. He has managed multi-billion dollar fixed income, credit, and currency portfolios, and his role involves credit analysis, trade execution, and portfolio construction. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting upon it. Please also refer to any product disclosure statement regarding the financial product for further information. Thanks for joining me today, Vivek. As a fund manager specialising in credit and fixed income, can you talk us through Perpetual's history and investment philosophy in this area?
Yeah, sure, Joel. When it comes to our team's investment philosophy about fixed income, we believe the most repeatable and reliable source of alpha in fixed income is credit. And when we think about fixed income, the two sources of alpha are either credit or duration. And the reason we believe that credit is the most repeatable and reliable source of alpha is because you have a very clear line of sight as to the end outcome of getting your principal back and your coupons along the way, provided you've done your homework properly on screening out default risk.
Okay. And when we talk about alpha, that's getting a return better than the benchmark. Which benchmark are you using as your performance gauge?
Yeah, so for the Diversified Income Fund, we're using the Bank Bill Index as our performance gauge. And history has shown that when you're investing in credit, investors have generally been overcompensated for default risk in terms of that credit yield premium that they can earn above that Bank Bill benchmark.
Oh, excellent. So what's the investment process you use when you make the investment decisions?
Yeah, sure. So we have both a top-down and bottom-up element of our investment process. So with the top-down component, our team get together every fortnight and we come up with our credit score, which is the team's 3 to 6 month outlook for credit spreads. And that credit score varies on a scale of -4 to +4 typically. And it's a process we've been running for over 2 decades. So it's been tested through many market cycles and has stood the test of time. That credit score or credit outlook is made up of 4 broad components. So the first one is valuation. So where are credit premiums today relative to their historical averages? The second one is some macroeconomic indicators. The third one is demand and supply in the local bond market in terms of maturities and new issuance. And the final one we look at is some technical indicators. So that's the first element of the top-down process. In that same fortnightly meeting, the second element is what we call our matrix of preferences. And so once we know what our risk appetite is in terms of that credit score, we then look at 3 sort of different buckets and where specifically we want to add or reduce risk within those buckets. So those buckets are industry sector, credit rating, and maturity bucket.
Okay. When you look at the risk, how do you assess the risk when making the final investment decision?
Yeah, so that sort of relates, I guess, more to the bottom-up element of our investment process. So when we're doing the sort of fundamental credit analysis on individual issuers, we're looking, to lend to companies or buy their bonds that exhibit those defensive characteristics that people are looking for from their defensive, fixed income allocations. So we look for companies with strong balance sheets, predictable cash flows, low susceptibility to event risk, leaders in their industry segment, and management teams that have been successfully able to execute on their strategy. So that's one element of the risk. The other one is market risk. So looking at the price or credit yield premium you're earning and how that stacks up, relative to other opportunities available in the market. So that's called relative value analysis. And you may compare, a particular bond to other bonds in that industry sector, or other bonds in that part of the capital structure, or other bonds with that sort of a credit rating. So there's many different ways you can approach that. And another sort of analytical approach we use is break-even analysis. So if we buy a particular bond, how much would credit yield premiums have to move against us before we sort of hit that break-even point and then start eating into capital, because capital preservation is quite paramount when we're talking about defensive assets, and so we look at things from that point of view also.
Okay. What are the opportunities and risks you see in the market at the moment?
Yeah, so at the moment, I've been de-risking the portfolio. I think at the riskier end of the credit spectrum, be it high yield or the bottom end of investment grade, where we're talking about triple B rated credits, I don't think as a whole you're being adequately compensated for the risks in the riskier parts of the credit spectrum. And so I've been reducing exposures there and rotating into the higher quality part of the credit spectrum, being AAA, AA and single A rated bonds. I think one of the other risks worth pointing out is, over the last few years, we've seen building risks in terms of government's credit quality. And I think, that's been a situation globally. During the GFC, it was a lot about banks and financials credit quality and the financial system's health. Whereas since governments responded to the GFC, responded to the pandemic, in responding to both those crises, a lot of governments around the world have taken on additional debt and haven't really got their fiscal house in order, post those crises, and continue to spend at those elevated levels. And so we've seen a deterioration in credit quality of some governments around the world.
Okay. So what's Perpetual's greatest strength as a credit and fixed income manager?
Yeah, so look, I think the two things that separate us from many of our peers is that we're credit specialists and we're active managers. So when things are sailing along nicely, a lot of fixed income managers will perform very closely in line with one another, but it isn't until you get that big volatility or market event that you really see the value of active management. And I think, if you look at our performance over time, you'll see that the things that we're good at doing is protecting on the downside when that volatility does hit, and then taking advantage of the aftermath of that sort of volatility in terms of actively rotating into good compelling opportunities and making more money on the other side of that volatility. So if you look at our peer relative returns, you'll notice that after those periods of market volatility, our returns tend to pull strongly away from many of our peers, because that volatility plays to our strengths as an active manager.
Right, okay. So talking about those sort of periods where there's been volatility in the market, can you talk us through a time where you've turned a period of poor returns into an investment opportunity and turn the performance around?
Yeah, sure. So I think the pandemic is a really good example of that. So about 18 months prior to the pandemic hitting, I actually started de-risking the portfolio quite significantly. And in fact, by the time the pandemic hit, I had the portfolio positioned the most defensively it's ever been when it comes to credit quality. I had over half the portfolio in AAA rated bonds. And even during the depths of the GFC, I only took that up to about 40%. So what that meant was that we were able to protect, the downside for investors in the portfolio when the pandemic did hit, but we weren't unscathed, and we did have a peak to trough drawdown of around about minus 4.7%. But because we were well positioned with over half the portfolio in AAA rated bonds, it meant that I had a lot of firepower to deploy into the volatility post-pandemic when risk was significantly repriced. And so I took advantage of that by cutting that AAA exposure by about half and rotating into longer dated banks, financials and corporates, typically in that sort of triple B bucket at the bottom end of investment grade. And what that meant was that we made a lot more return on the bounce. In fact, we made about double the peak to trough drawdown when it comes to the bounce in performance, and we made about 9.4% coming out of that period. So our job as a fixed income manager really is to get those defensive characteristics, in terms of low capital volatility, capital preservation, but then try to accentuate the upside on the other side of that volatility, and that really plays to our strengths as an active manager.
And that was a good outcome for clients as well. Now, what are the other investments that you've made recently for the portfolio?
Yeah, so I mentioned I've been de-risking the portfolio recently, so that means taking profit on some of our positions. And so what I have been doing is reducing the high yield exposures, reducing the exposures at the bottom end of investment grade, banking profits on our hybrid exposures at the bottom of the debt capital structure, taking profit on some of our offshore bond holdings. For example, US investment grade credit spreads currently at 27-year lows, and rotating back into Aussie credit, which is still, offering compelling valuations in a historical perspective. Australian credit spreads hit their post GFC lows back in 2021, stayed there for most of that calendar year, but today, are offering credit yield premiums above those post GFC lows. So, in terms of the things that I am rotating into, it's typically securitized bonds, so residential mortgage-backed securities, asset-backed securities, which are very high quality and typically AAA rated at the senior level. And I've actually introduced some government bonds into the portfolio recently as well, including things like New South Wales Treasury Corp and Queensland Treasury Corp, which are AA rated.
How do you stay up to date with all the changes that occur in the financial markets?
Yeah, so we have access to a lot of resources to stay on top of, things that are happening both globally in terms of macro data, but also, specifically with individual credits that we cover as well. So we draw on, our team's sort of deep resources in terms of the credit analysts and portfolio managers we have within the team. And then, of course, that's supported by information that we can get from ratings agencies, some of our broker counterparties, and our own internal research that we do, of course, and of course, reading the financial press as well.
What makes a good portfolio manager?
Yeah, I think particularly when it comes to fixed income and defensive assets like that, a healthy level of skepticism. So, fixed income investors are typically glass half empty kind of investors rather than equities, where they're looking at things from a more glass half full kind of perspective because they're looking for the blue sky. When it comes to fixed income, we're actually looking at, trying to preserve capital and trying to mitigate any potential losses. So we're always looking at things from a glass half empty kind of view, saying, what could go wrong? How could we lose our money? And then what are the risk mitigants that offset that potential risk and give us comfort around investing in those sort of things.
Now, Vivek, we've covered a lot of ground today. Is there anything else you'd like to add before we leave you today?
Look, I think I'd like to add that we're very thankful for the support of you and your investors in the fund. In fact, the Perpetual Diversified Income Fund has roughly doubled in size over the last 5 years and is now, one of the top 10 fixed income funds in the country in terms of size. And we've now also made the fund available as an ETF. So in August this year, we launched the Diversified Income Active ETF, ASX ticker DIFF, which has been off to a really strong start and has also been really well received by investors.
Oh, excellent. Yeah, it gives a different channel for people to invest. I appreciate you making the time, and I hope you have a great weekend.
Thanks, Joel. You too. Ciao.